Hey Bowtie Nation, Joseph Hogue here, and over the last few years, people have found different ways to fight inflation. Like we've had to stop buying clothes for our kids.
But they don't fit.
Over that time, companies have also tried fooling you, keeping prices the same, but giving you less. But then no one has found a way to truly beat inflation. Until now. Consumer prices have jumped 22% over the last 5 years, more than 4% a year. But I found 5 dividend stocks that beat the constant increase in prices by growing their cash payouts faster. 5 dividend stocks that will grow the cash they put in your pocket faster than prices at the store. I'll reveal those 5 dividend stocks to beat inflation, but more importantly, show you what to look for in these dividend growth stocks and how to find them. Let's get started with our first dividend stock, and this one will surprise no one in the Bowtie Nation. Diamondback Energy, ticker FANG, with its 5.8% dividend yield. Diamondback and other energy stocks have banked on record U.S. oil production over the last 5 years, and no other area has benefited as much as the Permian Basin, where the company has its assets. Despite a slowing economy, dual conflicts in Ukraine and Israel have kept oil prices higher. That's contributing to higher earnings. Diamondback expects to turn just 3% growth in oil production this year into a big earnings bump and a 7% increase in the base dividend. Analysts don't expect much for earnings growth from FANG this year or next, but that sales growth makes me believe an upside surprise is coming. In fact, on 20 and 40% revenue growth this year and next, either Diamondback will surprise on the upside for earnings, or it's going to be massively reinvesting in the business, which will still eventually raise those earnings from which the dividends can be paid. During the last quarter, the company did surprise higher on earnings, with a 50% growth in profits from the year before, and on 25% sales growth. That current $10.76 a year dividend, the base dividend plus special payouts, is a payout ratio of just 48% on its trailing earnings. It's not the lowest payout ratio in energy stocks, but means the company is actively reinvesting in growth and still has a lot of room left for earnings to sustain or grow the dividend. Now, including special dividends and growth in that base payout, Diamondback has increased its total payment by over 700% in the last 5 years. Now, there's no way in hell I think it does that kind of growth in the next 5, but this one will beat inflation and put more cash in your pocket. We're just getting started on our list, but I also want to personally invite you to get the Weekly Bowtie, our free weekly newsletter with all the stock market news, strategies, and trends you need to see. Each week before the market opens, I'll show you what I'm watching and the stocks that could highlight the week. It's all totally free, just something I like to do for all you out there in the community, so look for that sign-up link below. The price of gold is on a tear, and I'm watching several gold miners. First up here on our list is the largest, Barrick Gold, ticker GOLD, with its 1.97% dividend. Now that measly 2% yield wouldn't normally even qualify as a dividend stock in my book, but these gold miners have a lot going for them if you're trying to beat inflation. First, the price of gold continues to set new all-time highs, up 65% over the last 2 years as central bankers divest from the dollar. That's taken the gold miners here with the Gold Miner Fund, the GDX, up 76% over the period. Also, though, gold is the ultimate inflation protection, a real asset that rises along with your prices, so you're directly matching your biggest pain point, those prices, with something that's going to offset it. And at this point, gold miners are cash machines. This table shows the all-in sustaining costs for miners as of last year. That's the price of gold needed to cover production and field maintenance for these companies, and you can see it's way below the current price of gold at $2,700 an ounce. In fact, Barrick, right around the median price here with its 1,364 AISC, is producing at a giant profit margin on every ounce it digs out of the ground. Barrick is the largest producer of gold in Africa and the US, with the largest portfolio of Tier 1 assets, and has a growing copper exposure, which is also going to drive revenue as that electrification continues to change the world. Now again, that 2% dividend isn't going to trip your trigger, but earnings are expected to jump 39% next year on almost 20% increase in sales. On that kind of earnings growth, the company can't help but boost its dividend payout. Barrick is paying out that 40 cents a share annual dividend, a payout ratio of 46% on its trailing earnings. But what if we apply that to the forecasted earnings of $1.79 per share? That would mean the company will only be paying out 22% of its earnings when it's tried to stay in the high 30s and into the 40s payout range in the past. Needless to say, I see a big dividend boost in its future, and in fact, Barrick has doubled the dividend over the last 5 years. That's almost a 15% annual increase, 3 times the rate of inflation. A more respectable dividend here at just over 4% on Regions Financial, ticker RF, and possibly an upside kicker. Of course, higher interest rates destroyed bond portfolios held by the banks, as well as commercial real estate they loan on, so Share prices have gone nowhere since 2021, but that's changing now with the Fed lowering its interest rate. Regions has just 14% of its total loans in commercial real estate, about $14 billion of the $98 billion portfolio, which is much lower than the 60 or 70% we've seen with troubled banks like NYCB. That means Regions hasn't been hit quite as hard in the crisis, but just that overall negative investor sentiment in regional banks does mean shares have stagnated and are trading at a great valuation. The bank is expected to post 13% earnings growth on that rebound, not the highest on our list, but solid profit growth on 4% revenue. The payout ratio here of 54% on reported earnings is typical for a bank and drops to just 45% on those forecasted earnings over the next year. That should open up plenty of room for dividend growth. Despite the weakness over the last few years, Regions has kept its commitment to shareholder cash return, increasing the dividend by 56% over the last 5 years, growth that is sure to continue with the rebound. We've got 2 more dividend stocks to reveal, but just as important is how to find these, what you need to look for to know that the stock is going to be able to grow its dividend and beat inflation. For that, we're looking at 3 measures here: earnings growth, a low payout ratio, and a history of dividend growth. And of course, these all make intuitive sense. Dividends are paid out of a company's earnings, its profits, and a company not growing those profits won't be able to grow the dividend very long. And the payout ratio, that's the dividend amount paid out each year divided by the earnings per share. So if Regions Financials is paying a $1 dividend per share, and the company is reporting $1.78 in per share earnings, then it's paying out 56% of those earnings in dividends. And that's important for 2 reasons. First, a company with a low payout ratio compared to others in its industry is more likely to increase the dividend even if earnings aren't growing very fast. Even if earnings fall a little bit, the company with a lower payout ratio should be able to support its dividend because it has that buffer. Also, though, the payout ratio is important here because it tells you how much the company is holding back to reinvest for growth. A low payout ratio could mean a company is in a growth phase, reinvesting more to grow those earnings and eventually the dividends. And finally, that history of dividend growth is that confirmation you need that management was going to use these other 2 factors to grow the dividend. A company that has made that commitment to shareholder cash return is more likely to take strong earnings growth and a low payout ratio and use it to justify raising the dividend to put more cash in your pocket. Now, finding these 3 is easy on any investing platform. We can go here to the Analysis tab on Yahoo Finance to find the expected earnings growth for a company. Here we see Regions Financials reporting $2.20 in earnings a year ago, and while it's come down this year on trouble in that regional banking space, it's expected to rebound 13% next year, up past $2.22 per share. That's what I'm looking at here, that earnings growth going forward, and can it support at least a 5 or 10% dividend increase? Next, we see the company is currently paying out $1 per share, so that's the 25 cents per share dividend each quarter, 4 times a year. And going to the Statistics tab shows us summary stats for the income statement. Here we see Regions reported $1.78 in earnings per share over the last year, so looking for that payout ratio, if we divide $1 divided by $1.78, we get that payout ratio of 56%. Regions is paying out just over half of its earnings to satisfy the dividend. But again, the market is forward-looking here, and that's what we want to do. If we take that $1 dividend and divide it by the $2.22 in per share earnings expected over the next year, we see the payout ratio would only be 45% of profits. If that happens, it would leave room for Regions to increase its dividend or reinvest more in the company, or both. And finally here for the dividend history, we go to the Historical Data tab, and I like to look over the 5-year period. Then change to Show Dividends Only, and we see every dividend payment over the last 5 years. Here we can divide the current 25 cents per share payout by that 5 years ago to see Regions has grown its dividend by 56% over the period. That is a pace of 9.3% a year, more than twice the annual pace of inflation. Of course, finding these 3 statistics is just the beginning. You then need to compare them against those of their peers in the same industry and other dividend stocks. Strong earnings growth and a low payout ratio in one industry, so maybe financials, maybe nothing special among energy stocks, so you need to compare these measures against those stocks in the same industry to make sure you're buying the very best. Tronox Holdings, ticker TROX, is rebounding out of a very tough few years, but still pays a 3.4% dividend yield. With $2.3 billion in revenue, Tronox is the world's largest vertically integrated producer of titanium dioxide pigment, a chemical used in everything from cell phone screens to paint and AC filters, so very much a stable demand chemical. Being vertically integrated from mines to processing means the company controls its own feedstock and can better control pricing. Tronox had been in an earnings slump but is growing out of it, expected to report 36 cents a share profit this year from a loss of 15 cents a share last year, and to see its earnings jump to $1.28 per share next year. If it can just sustain that level of earnings, even without much growth, they'll be increasing the dividend beyond what we've seen. And despite their earnings slump, the company has been able to maintain its dividend since 2022 and has more than doubled it over the last 5 years, an annual growth of 21% in its payout. I'll highlight that next dividend stock, one with the fastest growing dividends in the group. But why wait 3 months for your money? The 5 in this video are great for dividend growth, but they won't pay the bills. For that, check out this video next, the 7 monthly dividend stocks to pay your rent, with yields as high as 16%. We see much the same picture with Goldfields Limited, ticker GFI, and its 2% dividend yield as we saw with Barrick. Goldfields is another world-class miner, though quite a bit smaller than Barrick, and more of a pure play on gold without the copper assets. Its own AISC is close to Barrick's and leaves a lot of room between it and the current price of gold for that cash flow. And here we see even faster growth expected, with forecasts for a 63% increase in earnings next year on 25% sales growth. That's going to mean a higher dividend if GFI can get anywhere near that EPS growth. Now, the company does have a slightly higher payout ratio on earnings reported over the last 12 months compared to what we saw with Barrick, but applying that 39 cents per share dividend to the $1.91 in forecasted profits, and again, we get a huge drop in the payout ratio. At that point, GFI would be paying just 20% of its earnings out as a dividend. Now, Goldfields pays its dividend out twice a year, so you're going to have to wait a little bit longer, but that dividend has grown 143% over the past 5 years, a 19% annual pace, and almost 5 times the pace of inflation. Get the weekly bow tie free with the link in the description, and see the stock market news and stocks I'm watching every week. Or click on the video to the right for the 7 monthly dividend payers that will pay your rent. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.